many companies, including those with fine earnings, are investing aggressively now in sales and marketing and R&D to make sure they capitalize on some of the biggest opportunities of our investment lifetimes. Now, I've been around in the business for 45 years, and I've never seen the opportunities I see now. According to our expectations, truly disruptive innovation, which right now is valued in the global public equity markets at roughly $10 trillion, roughly 10% of the global equity market cap. We believe that 10 trillion is going to scale to 210 trillion by the year 2030. And if you want to see the building blocks that make up that analysis, take a look at our Big Ideas 2022, where we size the opportunities that are evolving thanks to genomic sequencing, robotics, adaptive robotics, energy storage, artificial intelligence, and blockchain technology. And I might add, the valuations of our companies now, if you look at them from many different angles, are below those of the NASDAQ. And as I just mentioned, we do not believe that the NASDAQ, certainly not the NASDAQ 100, includes nearly enough disruptive innovation opportunities as our strategies do. The Fed raised interest rates 50 basis points this week. And I had been saying that I thought that would be a mistake. The markets are corroborating that it seems that the Fed is making a mistake. So we've seen the stock market go through a spasm. The S&P now, from its peak, is down 15%. The NASDAQ, from its peak, is down 25%. Pure play innovation strategies like ours are down 60 to 75%. So that's not just a spasm, that's a convulsion. And you'd think that innovation companies that are not in benchmarks are witnessing the end of their world. It couldn't be further from the truth. This is a huge inefficiency in the market, this tendency to move towards benchmarks in risk-off environments. It's ridiculous that the genomic revolution and blockchain technology and crypto assets are all behaving exactly alike. In fact, crypto assets began to correlate highly with the NASDAQ starting at the beginning of COVID. Before that, there was no correlation at all. And so we think this is an anomaly, a massive anomaly, and that with time it will correct and the efficiencies will be introduced back into the market. So that's the stock market. The bond market this year, year to date, if you use the 10-year Treasury yield and its proxies prior to 1940, year to date through April, and I'm sure even more so through today, the bond market has not seen worse performance since 1788. Think about that. This is like a tsunami and an earthquake together. I used to describe what was going on in the bond market as an earthquake, given the very low base of interest rates from which we started. Now, you might be asking why would that be true, given that the bond market was just a terrible place to invest in the 70s when inflation was taking off? Well, the difference between now and then is back then there were huge coupons. You know, interest rates they were paying were starting at 6, 7, 8, 9%. Whereas during COVID, we got down to 0.5%. So the base from which we're starting is very low. And that's why we now have a tsunami. The 10-year Treasury yield has gone this year from roughly 1.13% to 3.11. Again, huge percentage increase. High yield bonds, well, their spreads have increased, and now their spreads are relative to that treasury yield. And so their spreads have gone up from 2.45 to 4.08. So in addition to the 200 basis points or the 2 percentage points that the underlying bond has gone up, they have gone up another 150 basis points. So credit is becoming much more expensive. If you look at credit default swaps, which are very sensitive to stresses and strains in the ecosystem, essentially they're insurance policies that investors take out or speculators take out to protect against some negative eventuality. Those have gone from, if you use the CDX, which is a market, M-A-R-K-I-T, metric based on the 5-year credit default swaps, they have gone from 45 to 46 as of September 21 to 85, 86 as of today. Now, during COVID, they went up to 159, so we're not anywhere near there. During the fear that China was going to blow up in early 2016, they got to 128. Well, that's a little closer to 85, 86. But today, we are much closer to where we were in 2018, the fourth quarter. Now, what is the significance of that? In the fourth quarter of 2018, the Fed, the market was beginning to send signals that the Fed was overdoing it by raising interest rates each quarter. And so this metric hit 95 then. So we're at 85, 86. So the Fed is beginning to understand that there are stresses and strains out there, and that is why this past Wednesday, the fear that the Fed would raise interest rates 75 basis points, either this go around or next go around, Chairman Powell put to rest and said they were not contemplating it. And so he was considered, he sent, relative to expectations, a positive signal. And all the markets seemed to enjoy a run for that one day, based on the notion that the Fed was beginning to understand that maybe they're overdoing it. We think over the next month, now they have another meeting in June, over the next month, we believe that the Fed is going to get a lot of data. Today was one of those days with the employment report that is going to put another measure of caution into their cadence here. So we would be surprised to see another 50 basis point move. Maybe they do 25. We still think they're overdoing it and the markets won't be happy. But I think what's happening here is this Fed and the members of the Fed are so afraid that they will be stuck with the legacy of reigniting inflation and not being able to put the genie back in the bottle. They're so afraid of that they are they're speaking very fiercely right now, and they've made a bold move, 50 basis points, when the base is only 25 basis points. So we shall see. We've seen M2's growth decelerate from 27% to 9.9%. And if you look at it that's on a year-over-year basis. If you look at it on a 3-month moving average basis and annualize that, we're in the low single digits. And it's kind of consistent with what happened in the GDP report. Last month, I gave 2 points of view. Everyone's looking at the same numbers, but there were 2 points of view that were very different from one another. One was the economy's charging ahead, inflation's going to continue, rates will continue to go up. We don't think there'll be a recession, and so forth. And then the other one is, whoa, watch out, inventories are building, consumption is slowing down, consumer sentiment is falling apart. We risk a recession here. And oh, by the way, China and Europe are in recession. Well, I think that the first camp is capitulating to the second camp. It's still fighting this notion that GDP actually fell. This in real terms now. Take away inflation. GDP unit growth fell quarter to quarter at an annual rate by 1.4%. The consumption of goods slipped slightly. That's what we're expecting. Meanwhile, inventories are piling up. Government spending went down, as I mentioned. Imports surged. And so a lot of those economists and strategists in the first camp were saying, oh, that's exogenous, that's an anomaly, you've got to adjust for that. No, you don't. Imports surged and went straight into inventories. They canceled each other out. So you don't, so what's so fascinating about the world of economic experts today, some were trained in economics, to be sure. Many were not. They were trained. They learned after they got their MBAs, and maybe they didn't go into the depth that many of us had to back in the day when everybody came into this business with an economics degree. So there's a lot of superficial analysis out there. And a lot of cherry picking also in terms of indicators. And again, I'll go back to, as I hope I'm not boring you with it, but innovation does solve problems. And it is not being rewarded in the market right now. It's rewarded in the private markets. We have seen some down rounds. Many of those have been in more Me Too companies that are not involved in the truly disruptive innovation space. Given the route in the public equity markets when it comes to innovation, we'll probably see some more down rounds or pushing out of funding until the public markets become more rational. We do not believe the public markets are rational right now. The selling has been indiscriminate. Certain ilk of stock that algorithms and quants think do not belong or will not perform well in the next day or week or month. That's not what we do. We're focused on a 5-year investment time horizon. If you'd like to hear our analysts talk about their companies and stocks, and I think when you listen to them and when you read our research, which we freely give away, or if you tune into our analysts on Twitter, you'll see the kinds of conversations they're having with experts deep, deep, deep in the bowels of companies that are at the forefront of innovation. And you'll see how sophisticated those discussions are. You'll see how profound those discussions are, in terms of how they're going to change the way we work and live, and how much better they're going to make the world. So given the dreariness in the equity markets and the bond markets today, and now increasingly the commodities markets and crypto, take a look at our research, read our Twitter profiles for some hope and optimism, because I can't tell you how excited and confident we are that our platforms are going to transform the world and are entering exponential growth trajectories now. This is not about 5 years from now. We are now living the reality that was only a dream in the tech and telecom bubble. That was a dream, and you had investors piling into the dream. Today is the reality, and they're running away from it. They're running for the hills, running for their benchmarks. The decisions in the tech and telecom bubble ended badly. The decisions, those running away from innovation right now, we believe those decisions will end badly as well. So again, read our research for hope, optimism, and really a thrilling look at what the future is going to hold.